Over the past few months, almost everyone has been warning about upcoming inflation. Ray Dalio, Michael Burry, Warren Buffett, and even consumers worldwide have witnessed inflation start to take off in practically all goods and services. Not only that, but the majority of investors believe that inflation is going to continue to rise substantially in the future. However, as a typical contrarian, Cathie Wood thinks that the opposite is going to happen: deflation. The world has prepared for inflation, and the real black swan event in Cathie's eyes is actually a deflationary crash. This video will go in depth on why Cathie believes this and how data backs up her claims. Welcome to Cathie's Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. Cathie Wood started her career as an economist and has decades of experience to back up her claims. Therefore, it's vital that we see what Cathie has to say, regardless of any preconceived notions. In fact, in the early 1980s, two famous economists, Kaufman and Milton Friedman, thought that inflation was here to stay. On the other hand, Cathie Wood, a relatively new economist, thought that inflation was cooling off. In the end, Cathie was right. Now, not surprisingly, Cathie Wood is making her bold prediction against the crowd. The first signal pointing towards decelerating inflation is the money supply. The supply of M2 money has increased significantly ever since the pandemic started. M2 money is a measure of the US money supply that includes savings deposits, checks, cash, checkable deposits, money market funds, and certificates of deposit. Of course, with the rise of stimulus checks, it's not a surprise that M2 money has increased dramatically. However, Cathie Wood is seeing a trend, which is that M2 money growth is slowing down at a rapid pace. M2 money growth has slowed down from 27% in April this year to just 17% in May. This slowdown in growth is likely why the bond market has been rallying over the past few months. 10-year Treasury bond yields have been suppressed to roughly 1.5% after peaking at 1.7% in March. Because bond yields and bond prices are inversely correlated, this means that the bond market has been rallying as yields are going down. When this happens, we know that the bond market is predicting deflation instead of inflation.
The bond market could be rallying because of what I just mentioned about money growth. I don't think many economists have observed, I haven't seen it at least, that the money growth rate has been cut in half from that 27% to 13.8%. Maybe the bond market is focused on that.
You might think that the bond market has been rallying because of the artificial buying power of the Federal Reserve. However, the Fed has been purchasing bonds for months now, and this isn't a new variable in the bond market. The buying power from the Fed has not changed the entire time, as even when the bond yield spiked up in March, the Fed's buying power was still there. In fact, the Fed plans to sell some corporate bonds and corporate bond ETFs that it purchased in the pandemic. After the high inflation reports, Cathie Wood, like every economist, actually expected the bond market to sell off. Nevertheless, bonds have just continued to rally.
But I will tell you, with the CPI reports that we have gotten, PPI as well, much higher than expected, I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43, no matter how strong the economic data have been, how high the inflation numbers have been. And so the bond market is sniffing something out, I believe. Now, many will say, well, it's just quantitative easing. And I think quantitative easing was true at the beginning of this year and through March when we went from 0.9 to 1.74. So nothing's changed on that score, but the bond market is sniffing out something here.
As crazy as Cathie Wood may seem, she does actually expect inflation to stay for the next couple of months. The Personal Consumption Expenditures Price Index has shown that prices have increased 1.6% year over year in February to 3.9% in May. However, Cathie thinks that this inflation rate could increase all the way to 5%. So while inflation could heat up for the next couple of months, Cathie sees prices going down long term. The rise in oil prices is ironically setting the stage for deflation. The OPEC, which is a group of many countries that control the supply of oil, is determined to make back some profits by keeping the oil supply low. This may actually be counterintuitive. As oil prices have gone up, more and more people have begun flocking towards electric vehicles. During the pandemic, EV sales have increased disproportionately to fossil fuel vehicles. This is partly influenced by increasing gas prices and also the idea that EVs are superior to gas-powered vehicles. If oil prices continue to rise, then this will just incentivize more and more people to purchase EVs, which lowers the long-term demand for oil. Crude oil currently sits at roughly $75 per barrel, which is approaching the previous high of $77. Cathie thinks that oil will eventually go down to $3 to $12 per barrel. That's right, $3 to $12 per barrel. $12 per barrel would be an 84% decline from the current prices. If these low prices come to reality, substantial deflation would come.
One of the reasons is, of course, OPEC, and they have about 5 million spare barrels they could produce per day. They're not. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand. When they start seeing demand destruction because of pricing, I do think they'll start producing. And as you know, longer term, the combination of electric and autonomous electric vehicles, we think, is going to drive oil prices down. As I've said, now this is my point of view. We haven't done the research to get us here yet, but I think we could go down, back down to where oil prices landed after the cartel took over in the early 70s. And they went from, I think, $3 a barrel or $4 to $12 a barrel. I wouldn't be surprised ultimately to see us back there, especially as electric vehicles continue to take off. And they are starting to take significant share.
Another piece of data that points towards deflation is the purchasing power of the US dollar. In the past month, the dollar index has spiked up significantly. This directly contrasts with the fears of inflation in the dollar, as the dollar is actually gaining purchasing power compared to other currencies. This may be from Biden's corporate and capital gains taxes coming in lower than expected. Additionally, commodities have also been crashing lately. Lumber prices in particular have taken a sudden turn downwards, which Cathie Wood actually predicted before the crash happened. There are also a couple of other signals, including China's pork prices and copper prices, which Cathie mentions in the following clip.
Against, I think, the consensus expectation, the consensus short in terms of currencies was on the dollar at the beginning of this year. And the dollar is not going down. And that's also consistent with the bond yields coming down, surprisingly.
The last factor is consumer demand. Real consumption dropped 0.4% month over month. Durable goods consumption in particular is down 4.3% month over month, and non-durable goods consumption is down 0.5% month over month. At the same time, services consumption is only up 0.4% month over month, which is not as high as the decline in goods consumption. Overall, as demonstrated by the crash in commodity prices, goods consumption, and the slowdown of growth in the money supply, inflation might not be as serious of a problem as you think. On the other side of the debate, there are many counter-arguments, such as Ray Dalio calling out the bond bubble and Michael Burry claiming that hyperinflation is coming. Personally, I believe that in the long run, inflation won't be a problem. However, in the short term, inflation could be higher than expected as consumption increases across the board. Let me know what you think in the comment section below. If you're interested in my personal research reports, my buy and sell alerts, how I navigate my new $25,000 portfolio, which I have a goal of growing to $100,000, exclusive valuation spreadsheets, and my main portfolio, check out my Patreon in the first link down below. I'll also leave a link to the full interview I used down below. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.